Hello everyone, this is Alex Suslov, Head of Capital Markets at A&D Mortgage with our AD Weekly Digest. As always, we're here to shed more light on economic events, mortgages and market forecasts. Investors continue to look for clues on future Fed interest rate policy amidst Fed speaking engagements last week. Fed officials suggested interest rates would still go higher after investors were hoping recent weak economic data pointed to the potential easing. There is a belief amongst the Fed that inflation could still run higher, leaving the Fed poised to keep interest rate hikes ready to go. On the economic front, fresh data showed weekly jobless claims came in below the forecast, which further underscores the strength of the labor market. New U.S. home construction continued to decline in October as builders battled with a sharp cutback in housing demand. With this being said, turning it to Billy at this moment to shed more light on the numbers and forecast itself. Hello Billy, how's it going?
Hello Alex, it's all good. Since the CPI fueled fireworks show a week ago Thursday, markets have remained firm, though quiet, following those explosive moves that carried 5 and 10-year yields down about 35 basis points. Treasuries opened a little bit softer the following Monday. Remember, they were closed on Friday. But those early trades that Monday were the high yields for last week, and yields continued to push lower throughout most of the week. The ranges were smaller than normal, so kind of heading us into the holiday, softer markets, probably quieter markets. From the October 20th yield crest, the 5s and 10s have now rallied about 65 basis points against a backdrop of promised continued rate increases into at least February, at which point Fed funds should be near 5%. So it's becoming increasingly difficult to think we could see much more in the way of a recovery. Last week's low yields included a trade by the 10-year within a gap that was left on October 5th. That was the day after it completed a 50 basis point rally in just 5 days. And it was also close to a 38% retracement of the entire break from August 2nd, which is nearly 200 basis points below the October 20th yield crest. If that wasn't enough to dampen expectations for continued improvement, Fed governors speaking have made it perfectly clear that they are nowhere near finished raising rates, and they've stated bluntly that they're not even discussing bringing them back down. I believe that based on year-over-year CPI charts, we could have seen the peak in inflation. But remember that the Fed's job won't be done until not only does inflation stop going up, but it has to come considerably lower. So we could probably expect 50 basis point hike in December, probably 25 to 50 the first week of February, somewhat dependent on the next couple of jobs and CPI reports. So we're probably at 4 3/4 to 5% funds the first day of February. And with the 5s and 10s currently trading below 4%, it's hard to imagine too much in the way of further improvement from here. I've always felt we'd see a 3 to 5 month correction before these cycles up in yields that began in 2020 are over, but expecting that now seems a bridge too far, since it would take us beyond February and leave yields on 5s and 10s well over 100 basis points below Fed funds. So if the charts behind me that I watch every day were charts of pork bellies or corn or gold or just about anything other than treasuries, I might think that we could have begun a more protracted recovery. But the Fed doesn't have much to say about those markets. So for the sake of having a good holiday season, we should probably be thankful that we got 65 basis points out of a rally and be in the mode of maybe hoping for more but not really expecting it. Hope everyone has a great Thanksgiving. And with that, I'll kick it back to you, Alex.
Thanks Billy for the overview. This week would be slower with many people out for Thanksgiving holidays. I hope everyone enjoys the potluck with their families and get back refreshed next week. In the meantime, keep your pipelines locked over the weekend and stay safe. I also wanted to say special thanks for everyone who organized a hockey event last week. We enjoyed watching Panthers versus Capitals and met lots of our brokers and partners. It was great seeing everyone. Make sure to follow us on YouTube channel, like this video, subscribe to Billy's daily market newsletters to stay on top of the capital markets events. This was Alex Suslov. Thank you everyone and have happy Thanksgiving and stay tuned.